Most people tend to miss out on the fundamental logic behind investments when it comes to investing in companies. So, companies are structures that essentially exist to make money for the company itself. And the companies should be able to make money to become profitable, and at the same time they have this objective to grow as well. So these objectives are not really from the companies, they're from the ones that rule the company. And usually what you can see, especially on United States, is that most people start companies with the goal of expanding those companies, expanding infrastructure, expanding operations, create a product to expand the sale of a product throughout the world. So essentially, they're aiming to expand as much as possible the company for it to grow, to allow the company to provide more cash flow. And then in the future, after you actually expand the company, you start to be profitable and you just provide a ton of money for the company itself, and therefore the people that are working inside the company also benefit from it. So this basic concept is essentially the logic behind the investments on companies. So let me tell you that it's not because of some company to exist that they may be following these fundamental logics. So you have companies that are not really having cash flow, they're not being provided cash flow by their internal operations. So usually this is a concern when it comes to people to consider to invest on those companies. And in fact, what you can see is that because they don't self provide cash flow on the operations of the company, this means the company is always dependent on external money to come as investors or just people that provide capital to the company to keep going in terms of their own operations. So I would say that ideally you want to invest on a company that already has a product on the market, and the product already has been proven that it has a significance on this world, which means the product is relevant and is actually good for the public, provides some value. And so at the same time, the company should be having cash flow. They don't have to be profitable, but they should be providing cash flow to themselves. So a lot of people actually have a misunderstanding on this. There's a narrative being played, especially by the media, in which you shouldn't invest in any company that is not profitable. And that's because essentially they're getting cash flow for themselves, they're spending more than that, which means they're negative on their balance sheet. Therefore, you should not consider to invest on those companies. But the thing is, usually because the companies aim to do what I mentioned before, they're supposed to be growing in the beginning, not to become profitable. And this also is related to the money dynamics that are implemented on the system. So if you have profits, you have to pay taxes over the profits. And the taxes you pay are very significant, which means it's a lot of money that is just going to be sent out to not be useful at all to the company. So there will be just wasting money by being profitable because they're having almost 30% of their money to just be paying on taxes. So because of this, what they aim to do is to use the money they're getting to keep expanding themselves either infrastructure, either developing the product, either expanding operations throughout different parts of the world. So the aim is to grow and to optimize cash flow on short midterm. So this means essentially they're just bleeding the cash they're having by these early year stages in order for them to maximize on growth and grow as fast as possible. So of course that people that tells you you should only wait for companies to be profitable, what means is you should be probably starting to invest on a company after they stop to have this big growth that they have been having. But the thing is, for you to actually gain a lot of returns on your investments, you should aim to invest on a company that is small and has a lot of room to grow and expand their operations in order for the price to go up in the future. So, things are not really correlated in terms of the time itself when it comes to the price and how the company is operating inside. So you can be having a price that is even decreasing when the company is just behaving well in terms of self development and expanding their infrastructure and everything else. And then what happens is eventually, as things keep going well, and as the company may or may not become profitable, but even if they're not profitable yet, as long as they're able to offset expenses with the costs they're having, I mean, they're having like their balance sheet pretty much neutral. But if throughout that this time they were just expanding operations and now they have way more cash flow than what they used to have, now it's just a matter of just refining internal operations to actually allow them to become profitable. Because remember, when a company is aiming to expand, they're going to bleed a lot of cash either on marketing to allow their product to be more expanded throughout pretty much every part of the world they want to go for, and at the same time on developing the product itself, which is a very expensive thing to do. But as things get to a good place, they can start to cut these expenses and eventually they will become profitable. So, again, when this happens or is just about to happen, usually the price tends to catch up to the actual state of the company. So you can have a long period of time in which the price is not really correlated to any internal situation on the company, but then eventually catches up, and that's when you get your big returns. But this means you should be investing on maybe 5 years prior to this time. So you don't want to start when the company is just kind of finishing their big growth that they're been having from the past 5 years, because you're likely to just miss the bigger party. So you're not having the same returns. So again, the concept is fundamentally this one. And there's people also asking me about crypto. When it comes to crypto are pretty much technology companies as well. You should treat crypto like this. They're either technologies itself, when it comes, for example, to Bitcoin, it's a technology that you have. And then you have a bunch of projects, a bunch of different cryptos as well. And the project itself usually tends to be business operations. So it's essentially like operating like a company. They're just not regulated by the same rules that they usually have to be when they're listed on the public markets, which could be good and bad when it comes to some concerns. The good part is that they don't have to be complying with a number of rules that may just slow themselves down in terms of internal processes. But those things also protect you in some way, because those companies, by following regulations, are just obligated to be disclosing a lot of information from the inside, which provide you a more transparent environment for you and the people that are considering to invest. So again, there's good parts and less good as well. But what I can see is that there's a bunch of crypto projects that, for as promised as they can appear to be, some of them, or a considerable amount, you don't really see a cash flow business model. So they're not really having a way to get cash for it themselves. It's all about people actually buying and providing cash because they're just buying into the cryptocurrency or the project. So again, because I'm very centralized on cash flow businesses that can essentially self sustain themselves throughout their business operations, I like in our opinion, it's relevant for that to exist. So in case it doesn't exist, we usually don't consider to invest on those companies. And it also comes with some histories that we've been researching for the past years, in which actually investors took positions on companies that could not provide cash flow for themselves, and eventually things turned around because investors stopped to provide cash flow to those companies, and then those companies essentially just went bankrupt. So this is the problem, is like you may have a good company in terms of the technology you have inside, but if you don't have a way of actually self-sustaining the company throughout a cash flow business model, what happens is if things go wrong, everyone gets screwed up. So again, people can consider to invest the way they prefer. This is why I usually say, if you don't have a lot of information, if you don't know a bunch about this space, I recommend everyone to just use investment funds. It's just the best strategy for everyone that is not willing to learn a lot from this space, to invest and just have a very like low state mindset when it comes to this. Because the truth is, you shouldn't be concerned about this. The same way you're not concerned if your bank is going to go bankrupt and you have your money